I'm going to go first. My name is Lee, and I'm part of the Be Brave team. Be Brave. Um, my team members are Aaron, Sandra, and Shrijana, and myself, Lee. Okay, we're going to start with the financial performance. And we should have the first slide up, which is the total revenue. When we looked at the revenue, we steadily increased year after year, except for I think year 11. In year 11, the camera dropped about 14,000 points, $14,000 actually. But we recovered in year 12. At the beginning of the camera sale, we were driving revenues, but at the end, the sales, the drone camera was driving sales at the beginning, but at the end, drones was the one that was driving the sales. They were our bread and butter at the end. At the end of year 15 with our revenue, we ended at like $1.3 million. Next graph is the earnings per share. It was always in a steady climb for us. Around year 14, we dipped just a little, but at the end of year 15, we ended up on the upswing with $16.97. So I felt like if we continue on to year 16, we would definitely continue on that upswing. On return on equity, that's the next slide. You guys have the next slide up, right? Okay. On the returns on equity, we started strong at 38.9%, and we ended strong at 53.7%. We began to decline just a little bit between the years of year 10 and year 12, but at the end, we finished pretty strong. So we were good with that. On the graph for stock was on a steady incline year after year until our stock took a nosedive. It was year 13. Our price dropped I think it was like half the previous year's price. We went from, I think it was like around 300, and we dropped all the way down to like 140, somewhere between there. We did, however, started to recover in year 14, and we did end up strong in the end. In year 15, we went all the way up to like $4.80. So, $480, somewhere around there. So it turned out good in the end, but it was kind of scary when we dropped like halfway. And the next slide, which would be credit ratings. Okay, our credit ratings, it's always been good. We've always stayed around A and A+. It was climbing, and then we stayed steady at A+, but in the end, we ended at A. So our rating was still good. We ended up doing well. It was never a problem with our credit rating. And then finally, our image. Now, that's where we struggled the most. We really worked hard on improving our image, but it never really got where we wanted it. It peaked at 87, and then it dropped all the way. It dropped down to 81, and then it just continued to decline from there. And we ended up at a 76 rating. It could have been better, and I feel like if we had continued like to year 16 and beyond, our credit rating would eventually got better. But it was always a struggle for us.
All right. Be Brave strategic vision. We are focusing on making products of the best quality in the industry while also being able to compete with our competitors' prices. This allows us to have a higher net profit so we can keep growing our products based on our customer needs, basically year through year. At the bottom here is what our actual vision was stated for our whole company throughout the years, which is our mission at Be Brave is to help our customers reach to the skies and capture their dreams with the use of quality products and outstanding service. Here, this slide, if we were to continue to years 16 and 17 earnings per share, the graph below, you can obviously see that our earnings per share were pretty well and high throughout the industry. There's about 3 years where we were kind of, on the lower end of our competitors. So with that being said, in year 16, we will be shooting for a target of 22.97 earnings per share. This will be a $6 increase from year 15. Then for year 17, we would want our target goal to be $25.97, which will be a $3 increase from year 16. The reason why we're taking a little bit of a bigger jump in year 16 than we are in year 17 is because we did fall behind a little bit. So in order to make sure that we are aligning ourselves with our competitors and getting back onto the top, we need to shoot for a higher price in year 16 so that we have the chance to be back up on the top and we're not going to have to lose any of our shares in the end. The next slide, we have our year 16 and 17 return on equity. The picture below, we didn't do the greatest on our return on equity. We were high a couple of years above the company industry average. We weren't terrible, but there is definitely room for improvement. So in year 16, we would like to see our target of 63.7%, which would be a 10% increase from year 15. I don't know where that piece of information went, but and then for year 17, it'll be 73.7%, which would be another 10% increase from year 16. Again, hitting this target or going over this target will allow us to get back onto the top of the industry expectations and hopefully be able to have enough close margin in order to beat our competitors in the industry. This last slide here is going to be year 16 and 17 credit and image rating. As stated before, our credit rating has always been pretty decent. We never fell below an A. So with 16 and 17 years, our target will be an A+. That keeps us above and ahead of the game and makes us more competitive with everybody else in our industry. Our image rating did go down from the 81 to 78, 76, 79, and so on. So our target for both years is going to want to be an 85. This will make sure that we are going above the investors' expectations and getting back up to being on par with our competitors again, so that when we look back through the years before, the financial situations and how our competitors are changing their products, we are able to take all that in consideration and still be able to be up on the top. And then we have our AC camera competitive strategy. We didn't really have one specific competitive strategy. It seemed like it worked a little bit, but towards the end, we probably would have to focus a little bit more on changing things around based off of our numbers and our image rating and credit rating. So we're going to focus on what is going to bring us the best revenue while still being able to be among the leading companies in our industry. So we have always looked at numbers for the year before and strive to get those numbers, higher for the next year. We sometimes might have to lower some of the costs in some of our regions to be able to be better than our competitor prices. Again, we look at our competitors' pricing for each region from the year before and base our prices depending on what those results are. We look for making changes to bring in a high quality product for a price that everyone can afford, because we have always believed that regardless of the region's financial status, we do believe that our product should be able to reach everyone. So there may be some highs and lows when it comes to pricing. We don't want to just be in one region specific and believe that everyone deserves a chance to own our products in order to fulfill their action camera needs.
Okay, for the UAV drone, our price was high in the beginning when we first came out in year 6, but we did have a really high quality product. And up in year 10, when other competitors started to surpass us, like instead of us making any adjustment to it, we kept it that way, and I think we played it safe by doing that. Because when the market prices begin to increase for other competitors, we kept it same. So in most regions, we had lower price while maintaining the high quality. And for the next slide, that slide was not supposed to be there because I made the changes, so we can move on to the next one. Okay, so here, as you can see, we decided to increase the base ways of like camera and drone to employees by 3% in year 15. And that kind of caused imbalance with a decrease in employees on the camera side and a higher number on the drone side. Labor cost for camera declined after year 9 and increased at year 15 because of the upgrades we made towards the end. And we never added workspace for camera side, but we added 11 workstation and 10 spaces in drone side. That's why no overtime was needed in camera, but that was 46 hours extra in the drone side. And for the next slide, for the workforce compensation, like our graph is like fluctuated for both camera and drone due to changes in market, financial performance, and competitiveness. And the compensation for the UAV drone begins at $25,000 in year 5 and gradually climbs throughout the years, reaching at a high of $32,163 in year 15. And the compensation for AC camera over a period of 15 years, it shows that pay begins at $25,000 again in year 5 and gradually climbs up through the years, peaking at $32,416 in year 15. Thank you. And for the financial strategy, so like $11 was one moment, sorry. So Be Brave has like paid out $11 in dividends for its share of stock held by shareholders, and Be Brave has also paid out $216,865 in dividends to its shareholders in total. And our company has 54% of its financing from debt and 46% of its financing from equity. And this ratio indicates that our company has a moderate level of finance leverage, which can increase the company's profitability and risk. And to achieve and maintain a strong credit rating in Glo-Bus, our team will maintain a low debt to equity ratio and avoid defaults. And to keep a good financial position, dividends must be balanced with our other financial priorities.
All right. For our closest and strongest competitors for AC cameras, we can see here the chart beside us is a segment. It plays out a detail of how Adventure Tech pushed for a very high price, but amounted to an amazing PQ rating and brand reputation. Also, they had a huge sale promotion running for 10 weeks at 30%. Pretty hard to compete with that. What became competitive between us two, Adventure Tech and our company, was the number of retail outlets. As you can see, they have 200 retail outlets versus we have 190. We also had about the same number of demand for what we both sold, which came out to, let's see, we sold, to what we sold. Company ClickTech was also the strongest competitor for AC cameras in our industry for the past 2 years. They offered a low price with a nice brand reputation, which gave them a gain with market share. Next slide. So our closest and strongest competitors for drones came to be also Adventure Tech as well. They pushed for a very high price, but amounted to an amazing PQ rating, just like before. The competitive area for the two of us was the demand for drones as well. We dominated this area more for a demand of 83.4 drones to their 78.5. We also had a better market share of 20.6% to their 19.4%. So it was getting pretty competitive between us two. Company ClickTech was the strongest competitor though. They were really on a roll with having a low price for their drones, just like their AC cameras. They did lack with having a lower PQ rating, but a very nice brand reputation. They also pushed for less retail support, advertising budgets than all other companies, and coming out to a market share of 25.6%. So they were really on a roll. I think they were dominating there. Next slide. Actions to take out our closest competitor. So focusing on like the future, we wanted to look at the marketing. We want to increase brand awareness and attract new customers. This would help build a loyal customer base and increase sales. We also want to look at possibilities of ways to reduce our cost, focusing on our cost by optimizing our supply chain, improving our product processes. Also, by expanding product line, we can add more drones, more AC cameras, to look, and we just got to see where the competitiveness is within that. This action would introduce new and innovative products to the market to cater their evolving needs of our customers. In return, this would capture a larger market share, and that's what we're ultimately after. And we want to stay ahead of all our rivals. Next slide. Actions to take out our strongest competitor. So we want to look at ways to improve our product quality. By doing this, we'll focus on the needs of our customers to build a positive reputation and increase loyalty. We want to...
Whoa. I did not press the button, I promise. Sorry.
Thank you. We also want to develop new features. Invest in research and development to new areas that would make a difference to our strongest competitors, which will capture a bigger market share. Next slide.
There we go.
So with lessons learned, so with us being on the top within our industry, and even being in the top within Glo-Bus nationally. It's very dissatisfying to see where we ended up, honestly. So some of the lessons we really learned with that was long-term visions. Be Brave struggled with investing into research. I think that was a really big problem. And research and development. That was a really big problem. I think that bit us in the butt. I believe if we would have done more in this early on, we would have been ahead of the curve. And also being more flexible. This means adapting to the changes of competitors. Growing tighter or a shift of consumer preferences is important to know and follow along and study your competition. So it's very dissatisfying, but I could see though at the very end, I think next year, I think we would have been even more competitive with Click Tech, Venture Tech. I just feel like we would have been gaining our momentum back to where we were in the beginning. And I think it is hard. It's hard to see where we were, but I think that we kind of understand what happened there. And I think that's the end there.